Welcome to Trading Digital and Financial Assets Technical Analysis in under 5 minutes. This is absolutely not financial advice. Technical analysis, also known as TA, as you can read here in the Wikipedia definition, is an analysis methodology for analyzing and forecasting the direction of prices through the study of past market data, primarily price and volume. Or another funky way of putting it, studying past price data in order to come up with an educated guess of where price may go in the future. This is a game of probabilities, and it is absolutely not witchcraft. In this video, we'll cover price analysis via price charts, price lines and candlesticks, trend lines, supply and demand, patterns, indicators, and we'll round up with a very important concept called Confluence. Price analysis, we do that via an awesome tool called TradingView. There is multiple sources, multiple softwares that do this, but TradingView is our personal favorite. And in this chart, you can see the price of gold. On the bottom, we have the dates, and on the right, we have the price. And if you connect them, you take a price point every single day. Throughout time, you can see that a line can be drawn. Now, that line is a trace, and that line we can analyze. We can do so with multiple assets at the same time. For example, Bitcoin, sugar, gold, and Amazon in this case. And you can see, the reason for some traders using many screens to do this. Is this necessary? Not really. You can get away with fewer screens than we see in the bottom right. One reason for doing this, though, is the hunt for uncorrelated assets. So assets that move out of synchronicity with, for example, the market that they're trading in or the index that they're traded in. And in this way, find assets that show a particular price behavior that we can work with. That is not important for now. Right now, let's stick to the basics. So price lines on the left, a pure line. We can also depict that in a different way in what we call a Japanese candlestick, which may look something like this. Over here is the Heikin-Ashi candlestick. You don't need to remember that for now. But what you do need to remember is that they look like this, and they come usually in green and in red, meaning that if price goes up, the candlestick is turned green, and when price goes down, it is turned red. Now, focus your eyes on the center of the screen over here where we see a candlestick basics. A candlestick consists of 4 points: a high price, a low price, a open, and a close price. What does this relate to? Well, this relates to a certain trading period. And the trading period can be a day, it can be 4 hours, it can be 1 hour, it can be a week, it can be a month. And a candlestick can depict you 1 month of trading data, for example, and within that month of trading data, it can show you the highest price. So the highest price has gone, the lowest it has gone, the opening price of that certain month, and the closing price. Why is this important, and why can this help us? Well, if you just focus to the right a little bit, we go to where it says bearish engulfing. Let's say that price moves, the left candlestick is white. Let's say that it moves up, but then the very next trading period, it is smashed down, basically erasing all the price upward movement from the previous day. This can help us tell that there is a probability that price is not going to continue up higher, but there's a higher probability that we actually go lower. If we go all the way to the left, you see bullish kicker and bullish engulfing. That will be the opposite, where price goes down, certain trading period, but the next period, that trading period, that price action is completely erased, and we actually go to the opposite side. Game of probabilities, remember that. Next up, trend lines. They say the trend is your friend, and your eyes can already see that this is a price trending upwards, as we say. Now, why do we draw trend lines? Is it necessary? Well, sometimes, as you can see over here in the Amazon chart, it can help us determine when a downtrend comes to an end. This is very simplistic, but it does nonetheless provide us with a clue. So in this case, Amazon was trending downwards. All of a sudden, price breaks through. You see a very large candle, and after that, it's just a rocket ship going all the way up. Next up, supply and demand. Let's just start on the left of the chart over here, where you can see a price point. I've made a red bar that indicates that is a price level where every time price went to that price point, so this is around $16 something, there were always sellers not letting price go higher than that, and it was a point to sell. But then something curious happens with the arrow and the rocket, where we visit that price level again, we break through to the upside, and then we actually go higher. Now, an interesting thing about supply and demand, also known as support and resistance, is that what has previously been resistance may turn into future support, and you can actually see that happening as I colored the same bar green. Price revisited that area of $16, but instead of it being resistance and there being supply, so a lot of sellers, now it was actually a lot of buyers. The opposite happens at the top, the red bar, And if you just continue to the right, you see red turning into green and green turning into red again. And this marks, and this is Tesla by the way, this marks supply and demand zones. And this is potentially a probability that where price was resistance in the past, it may serve as an indicator that it will be resistance in the past, support in the current day, right? And you see that at the top bar, the red one, which turned green during the COVID dip, that actually what was previous resistance on Tesla proved to be a perfect point to buy before we again rocketed our way up. Another example is the S&P over here, over a period of many years. Resistance area in the .com all the way on the top left, so where price rejected, we see that red bar. That was the .com bubble, after which we had multiple years of selling. The next time we visited that area was again a point where sellers stepped in, and that was actually the beginning of the 2008 and 2009 financial crisis. Also, the green bar showed that the dip after the .com bubble proved again to be that at least that area proved to be a good point to be a buyer for the foreseeable future. So you could have been a buyer at 2009 when everybody was still very negative about the market, but it actually showed price. In this case, the technical showed you that was an excellent point to be a buyer. Patterns. Plenty of patterns, a lot of them, but in this case we have an ascending triangle. So again, we have a supply area or a resistance area. Every time price visits that area, it gets rejected, we say, but every time it got rejected, it went down, but it didn't go lower and lower. It actually ended up just a tiny bit higher than the previous time it was rejected. Now, when that happens in price, we can actually paint a certain pattern in this called the ascending triangle. The probability of this triangle is that when it breaks to the upside, so when it finally breaks that resistance to the upside, price more often than not moves higher rather than lower, right? So this gives us an indication of what to do. The opposite is also true. So in ascending triangle, we have descending triangles as well. As you can see, they kind of played out in this example of Bitcoin. They don't always play out, but they are a piece of the technical puzzle. There are many patterns, and you can all check them in your own time. I definitely advise to do so. Indicators. Another method, it derived from price. Price is absolutely leading. Without price, we don't have any patterns, we don't have any indicators, so please keep that in mind. In this case, I've depicted two indicators, so the relative strength index at the bottom, and two lines, a red and a blue one. The relative strength index can tell you something about an asset, whether it's overbought or oversold, meaning that potentially sellers or buyers have gone a little bit cuckoo. In the example where I've drawn the arrow in the red area was quite recently on Bitcoin. There was very strong selling, but that indication when the RSI measures so low, it could be potential that there has been too much selling, and we call that oversold, and it could be potentially an area for buying. That's one indicator, and there are really hundreds of indicators out there, but this is one of the most basic ones. That's how this works. The moving averages, the other two lines that I depicted on the chart, it measures the average trading price of a certain trading period. In this case, I think it's the 50 and the 100. So 50 trading periods and 100 trading periods, the average price of that gets depicted as a line. And one strategy that we can apply is every time the short term, so the 50 moving average crosses above the longer term moving average, we can say we're in a bullish trend. And for the entire duration of that period, we can be a buyer. That could be a potential strategy. It can help us make sense of the market. Now, I've also made two tiny little squares, a green one and a red one, where actually the longer term moving average, so in this case, the 200 periods, it proved to be when price actually visited that exact line on the left side with this green square, it was a very great time to buy, and the opposite happened when it revisited it from beneath. It was actually a good time to be a seller. Nothing guaranteed, but they are all clues to making sense of the puzzle. Important is that one signal is never enough to go on. Watch for multiple signals coming together, whether they be fundamental, technical, an indicator signal, or pattern, or a weather report, whatever you will. An example of this, we have a rising wedge pattern on the Bitcoin chart over here. We have this moving average crossing to the bearish side. Volume is also going down, but price is moving high. And as you can see on the RSI at the bottom, it is going from an overbought area to all the way down, while price does the opposite, and we call this a divergence. In this case, price was actually diverging from volume and from the RSI. This all together means that at that certain point in time, around the 64,000 mark, there was weakness in the market. And it was potentially a good point to take some money off the table, take some profits, maybe step back a little bit and prevent yourself from that downside that followed. All these signals coming together is what we call Confluence. And this is an introduction to technical analysis. I hope you liked it. Thank you for watching. Follow us on X at TDFA course.